Dividend investors, bonjour, this is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. Today we're talking about how to position your portfolio according to different sectors. The market is down for a few days now. We might have another crash, so you want to make sure that your portfolio is well invested at this time. But first, I want to thank Jason from GMAC Investing. Yesterday we had a YouTube live for an hour. I know that a bunch of new subscribers subscribe to my YouTube channel, and if you haven't done so, just click on the subscribe button there. Publishing like 2-3 videos a week. Was great fun. You want to check GMAC Investing YouTube channel as well. I've put the link in the description below. Great time, fun guy, and he got lots of traction recently because he called the shot on Nikola Motors a few months ago, and now it's getting very popular, getting lots of traction, and obviously he was among the first YouTubers to discuss this great company. But it doesn't pay dividends, so I cannot comment on it, right? Alright, so now how about looking at your portfolio and make sure that you have the right sector according to your goals, according to what you're looking for and what you want to do with your investments. If you are scared, if you are afraid, if you expect more volatility and you expect that the market's going to go down again, there are 3 sectors that you can put your money, and that will be like completely like a safe haven. I will discuss stock pick. I will tell you more about all the stock picks for each sector at the end of this video. Now we're just going to go through all the sectors all at once. So the 3 sectors we're looking at is obviously consumer staples, groceries, food and beverages. People will still need to clean their house, brush their teeth, so all those companies will still do well. They will not thrive, obviously, but they're kind of like recession-proof. They're classics when you're looking to protect your money. The other sector, I think, that will not be touched too much by the current recession is healthcare. Obviously, the problem we have right now is related to health. So along with the big pharma, I'm looking also at medical device companies. We will still need those to be up and running, and they should do well. It's a great place to just park your money there, make sure it doesn't get hit too much, and what you've seen so far in March and April, those are companies that didn't hit that hit on the market either. Finally, super counterintuitive, because a lot of people are looking for growth when they're thinking about this sector, is the technology sector. Old tech stocks paying dividend like Microsoft, Apple, Texas Instruments, Cisco, Intel, name it. There are plenty of them. They're sitting on piles of cash, and their business model is custom made for a pandemic. They help other businesses, they help consumers to run with their lives through cloud-based application, through services. So everybody needs a computer and a smartphone right now, and they are there to help you out. So those are the 3 places where you can put your money, and obviously they're more expensive right now, but if the market goes down by another 40% or 30%, like a lot of people likes to expect the apocalypse, well, those places, tech stocks, consumer staples, healthcare, will help you to go through the storm a lot better. Now, if you're looking for growth, if you're looking for opportunities and you want to make some educated guess on those, there are 3 sectors where you can find actually pearls. First one, financial services. I will not lie to you, it will be difficult for the upcoming month. It will likely be difficult for the rest of the year. However, large assets manager, they'll do fine. Banks, especially Canadian banks, I mean, they now offer you a 5% yield. It's just a biggest deal on earth right now. I don't expect dividend increase in this sector, but I'm pretty sure that Canadian banks will hold on to their dividend payment throughout 2020. They're well capitalized. They're ready to face a recession. There's not too much to worry about it at this point. Obviously, if there's a second lockdown in fall, we're going to have another video about it, because it will be a totally different story. But for now, this is a good place where you can start and buy cheap stocks, great yield, and expectation of dividend growth in 2021, 22, 23, and so on. The second sector that I really like right now is industrials. Industrials are one of my favorite sector, and I'll tell you why. Because they are incredibly cyclical. So basically what it means is when the economy goes well, it goes well. And then the recession, whoa, and then it goes down. So each time it goes down, perfect timing to invest in those. Quick example, 2016, there's the oil bust, the fear of a recession, and then all the trains, all the railroads like Union Pacific, Canadian National Railways, CSX, and Canadian Pacific, they all went down like big time. Well, it was a great opportunity to buy some Canadian National Railways and Union Pacific. And then what happened in the upcoming years? Oh, finally, no recession. The economy is doing well. Train goes back up. You made a great profit. That's perfect. I will be discussing some very interesting stock picks in the industrial sector at the end of this presentation. So stay tuned. Now, the last sector where you can get lots of growth is obviously consumer cyclical. This one is very tricky. Everything related to travel and leisure, entertainment, restaurant will be very difficult. So make sure that you select companies that were doing well in the past 5 years. Basically from January 2015 to January 2020, those are companies that you look at must show a strong dividend triangle. We're talking about revenue growth, earning growth, and dividend growth for at least the past 5 years. If you don't have that, this means that the company was not able to thrive when the economy was rolling, unemployment was at lowest, consumer sentiment was like incredibly high for their sentiment, and obviously debt was cheap, great appetite on the market for debt. So basically perfect environment for consumer cyclical to thrive. Those who didn't make it the last 5 years, they won't make it right now. So forget about those. So this is where you put your focus. So you're looking for growth. We're talking about industrials, consumer cyclicals, and financial, mostly in the subsectors of asset management and Canadian banks. I would not necessarily go towards life insurance businesses. Now, I know that lots of retirees, income-seeking investors are watching this video. I didn't forget about you. We're now talking about the income part of your portfolio. So we have the safe part with tech stocks, consumer staples, and healthcare. And then if you want like some higher yield, you want to look at utilities for sure. Yes, their revenue will go down 10-15% throughout the next few quarters. The economic lockdown will affect commercial and industrial power demand, but over the long run, those are stable dividend payers. You can find great ones across America. So regardless if you're looking on the Canadian side or on the US, I have a slight tendency to look at those that are focused on renewable energy for obvious reason, but this is a great place to start. Another one, telecom, AT&T, Verizon could be interesting at this point. I see them more as a deluxe bond, but still great yield. Lots of people need connectivity right now. It's pretty much the only thing that is keeping the society together is pretty much our smartphones. So we want those companies in our portfolio. And the Canadian sector is perfect for that. Bell and Telus, great businesses as well. So you can have like a good 5-6% yield, which is relatively safe compared to other sectors. Great place to find income. And finally, one of the most favorite sector for income-seeking investors are REITs, right? Be very careful with REITs. Everything that touches retail, I would just forget about it right now. To be honest, I was not a fan of Tanger Outlet and Simon Properties in the first place a few years ago. Messerich, same thing. So all those REITs, just forget about those. Focus on warehouse, industrial REITs, data center, cell towers. Those are companies that will help you out in this pandemic. They are built to provide distribution center, more data. Obviously we need data, and then it will not slow down the development of 5G. You know, 5G technology is not dependent on the virus. The virus cannot eat it up. So this will continue to thrive, it will continue to expand, and we'll still need cell towers and data centers in the future, right? So those are the sectors that you should focus. Obviously, I forgot about the last two, which are the energy sector and basic materials. For energy sectors, I don't know, if you want to play your money. You can use a 5-10% and try to gamble there, but for me, they make very poor dividend growers. They depend on oil price, they have no control over it, and this is very hurtful on their cash flow. So they never know from one year to another whenever they're gonna have to cut back their dividend, slow down their payments, slow down their capex. It's very a bad business for dividend growers. This is why I don't like this sector. Then if you move towards the basic materials, a lot of people will tell you, oh Mike, you forgot about gold. We must invest in gold, right? Because hyperinflation is coming, the Fed is printing money, yada yada. Yeah, well, just quick reminder, go back in 2008 for a second. Remind yourself of what happened there. Gold went like this, and then what happened? Oh, 2010 arrived. We finally realized it's not the end of the world, and it's not the end of capitalism, and then banks are still rolling, and consumers are still getting debts and paying stuff, and the oil goes back down. You know, throughout the entire history, gold has shown to be, yes, a good protection when things turn sour, but the growth potential is the inflation. I mean, an ounce of gold today is worth pretty much what it used to worth back in the Egyptian time, back at like minus 5,000 years ago. So basically, you're not getting much out of it. And when you look at companies like mining companies, they're doing well right now, but they've been doing very poorly during the last economic boom. So this is why I'm like, well, yeah, if you want to do it in and out, then again, be my guest. Play with 5-10% of your portfolio, but don't expect much from it. It's a temporary protection. I think that the real protection is to have a sound investing strategy and focus on strong dividend growers. Those businesses, yes, their stock price will fall, but their dividend will remain the same, and once the economy restarts, they will be thriving. And the key part here is they will be thriving before you even know it. And then when you wake up and it's too late because they're up 30%, you're gonna think, what again? Oh, it's undervalued, I'm not gonna go for it. And then you're gonna miss on a great opportunity once more. So this was about all the sectors I want to discuss today. Obviously, I haven't discussed much picks, right? Because last month I did a complete webinar offering you like 5 to 10 stock picks ideas per sector. So it's a huge webinar. It's about an hour presentation, and you'll get roughly like, I don't know, maybe like 60 suggestions that you can look into it. The webinar was done a few weeks ago, but it's still very well put for the current economy, the current situation. So click on the link below. It says webinar, and then you click there. You can register. It's 100% free, no strings attached. Register there, watch it, and then there's a Q&A at the end, so all questions and answer, and you can even skip to the questions that you really want to have the answer and not watch the entire webinar. So I hope that you have liked this video. Subscribe to my YouTube channel if you haven't done so. Welcome to all those that have been there with me for the past couple of months. I'm starting to have a lot of fun to do those videos. I'll make sure to post something else next week, probably like another 2 or 3 videos. And until next time, stay invested.